Thank you, Carese. It's always a pleasure to have you on. Well, first of all, always a pleasure to work with you and have you on the other side of a transaction, but then also to get some one-on-one time and pick your brain on what's going on actually in the market. Just because you're a wealth of knowledge, and I don't know anyone else who knows quite the condo market and the market in general on the lending side as well as you do.
Thank you. Well, it's always a pleasure. It's always a pleasure to get to talk with you. And I feel the same way. Like love working with you. And yeah, there's so much to talk about. There's so much going on in this market. And I'm sure so confusing for consumers. So hopefully we've got some consumers that are joining and will find this helpful and navigating. And yeah. We're learning every day.
It can be confusing for us professionals too, but yeah, like you said, on the consumer standpoint, when you step into something, you know nothing about it, and then you have these added layers of everything that's happening in real time. And then you add the media to it, and you add what is real, what is not, what should I know? It's really hard, and then it becomes very, very important to have the right people in your corner who know how to guide you, who know how to kind of condense and make the information more palatable and approachable, because I think buyers especially get really frustrated and even kind of turned off in the process just because there's so much going on that they don't know and they can't grasp.
Yeah, the media is the worst on this. First of all, they're never in real time. They always lag. And a lot of them don't understand it themselves. And so it's just information that's put out there that's in a lot of cases just blatantly not accurate. And I think this generation, this Gen Z, is, although a very smart generation coming up, very fiscally savvy. I think it's going to be probably the toughest generation that we've seen in a home buying. It's going to be it's going to be toughest for that of the generations that we've worked with. So.
And the reasons for that is just because the changes in, I guess, the atmosphere. I know we have on the real estate side, on the brokerage, on the representation side, we have that extra element that we're kind of working through this year. But from your eyes, what are you seeing are the biggest hurdles for this generation?
I just really think the market, I'm going to flip to the next kind of what I see right now that I think is really confusing, and what makes the whole market complex is, as we know, there's always opportunity in every market. It's really trying to cut through the mud and get some clarity. But you've really got, I would say right now, got a couple big things. Stubbornly high interest rates. All right. There's a couple reasons why that can be problematic for people trying to buy a home. I mean, one obviously is affordability. That combined with the low inventory market drives prices up, because there just isn't even remotely enough inventory coming online in years in my lifetime that we see currently, unless there's some massive changes that come down in the next, few years. It's going to push prices up. It's simple math. There's just more people that want to buy than what there are homes. But I think on the interest rate piece, there's so much focus put on it, mainly by the media, that that's the main driver. And the problem of it is, and this is going to shock some people when I say this, it doesn't even matter what the rate is right now. It truly doesn't. That's actually not really what the focus should be. If you want to buy a home, your focus is price. In 5 years from now, when you look back, are you going to care more about the rate you got or the price you paid for that house? Because the reality of it is, if you go back 50 years in our economy, the way the US economy works, it can be erratic. It can go up, down, sideways. If you're in it long term, it always evens out. The cycles are about 5 to 7 years. They're a little bit longer this time, I think, maybe more like 7 to 10 years. But the reality is, anybody buying it last year, year before, this year, you're going to be able to refinance in a couple of years, and you're going to get that new low market interest rate. So you're going to ultimately get what you want. But the thing about it is, by the time you get that, the house that you would buy this year is going to be worth 20% more. and you likely may not be able to afford it. So that's where I feel like the whole conversation around stubborn rates is that's always the main thing people are talking about it. In reality, it's probably fourth or fifth on the list as really being the most important thing, but it's a headline. And so it grabs people and it makes people scared to move forward. Low inventory, as we know, just continues to be an issue. With that though, I see the opportunity is in condos. And we'll get more into that, I know, in our conversation, but I just think probably the greatest opportunity right now in the market is really condominiums, because as a first-time home buyer or a move-down buyer or just a lifestyle buyer where you just want to have the lifestyle of being able to like have the simplicity of like having this great space to live and not having to worry about the maintenance. Gosh, you can go in there and not have nearly as much competition as you can if you're trying to do a single family home.
Yep.
Yeah.
Yeah.
Trends also, I am seeing some unique programs come back, as well as, programs we haven't done in 10, 15 years because they didn't make sense in the market, but also some unique ones that I'd love to talk about in a little bit. And just really focusing it on strategy. I cannot emphasize enough, like for a buyer, it's really important that we have the conversation early. Whoever their loan officer is, they really need to be on board and partner with their loan officer, partner with their realtor, because it's a team effort and it's a long-term plan of the strategy that needs to be used. I mean, maybe there's some things in their personal profile or their financial profile that need to be tweaked or improved before they're going to be buyer ready. And as you know, these markets can shift. We're now starting to see some multiple offers in many segments. You can't just wait until the last minute to get your pre-underwriting approval done, because you're going to miss out potentially on a house. Yeah. So that's kind of the highlights.
Yep. And that is the shortage of inventory. And we are seeing multiple offers. I mean, I was at a breakfast group yesterday and, up to 500K in escalations. I mean, that is right back to where we were. And like you said, to the point of all this, it's not stopping people from getting financing, right?
No.
Because players in their life and the things that are going, and they have probably the mentality of buying now because you have to, or because, this is the time to do it, because if you wait, there's no waiting, right? Because who knows in the future with the valuations and even the interest rates, to be honest. I mean, we all think that maybe we'd be able to, refi in a couple of years, and we hope so. But there are also indicators, and you might touch on this too, that, obviously when the economy is not doing that great, that's when the interest rates kind of come down too. So, that's another delicate balance that you always kind of have to think about.
And that's I think what's interesting right now. I mean, people, the biggest drivers of people moving and buying homes is to be closer to family. They move to be closer to family, or they're relocating for a job. But we're also seeing some unique strategies that people are doing too in home buying, which I know we'll touch on too. But to your point on inflation. So inflation right now is really the driver in interest rates. Like it's absolutely the number one concern. And the problem of it is this is more stubborn inflation than what we've seen in the past. It's a lot different than, like, people probably heard about inflation in the mid 80s, and it's a whole different ballgame in this one because of the amount of debt that we have in our economy. And the spending that has taken place in recent years has really driven up inflation. And it's just being perpetuated. And what you're seeing energy prices going up, motor vehicle insurance, homeowners insurance. I talked to the agent I've worked with for 20 years. He said he's never seen an increase in homeowners insurance than what he saw between 2023 and 2024. And that's mainly driven by cost of labor, cost of materials. It's all risk-based. But even like, vehicle repairs and apparel, it's all gone up. Everything is just more expensive. And it's not going to come down quickly. There's a lot of people that just feel really strapped, and they're kind of learning to live differently, and have a different expectation, at least for a while. And it's going to be a long haul before we hit that 2% level that the Fed really wants to hit. The predictions that are out there still think 2 rate cuts by the end of the year. I don't know. I don't know. It'll remain to be seen. But I think what I'm looking at is there's still a lot of money in this economy. I mean, when you just look at regular things, when you see a Super Bowl that is sold out at the highest ever recorded ticket prices, people have plenty of money to buy that. Or Taylor Swift concerts across the nation and in world, I would assume too, but where the secondary market, the aftermarket on those tickets is 10 times what a regular ticket price is. People still have money to spend. And the reality is the Fed is not going to come in and lower interest rates, which stimulates the economy. And when there's that much money still on the table, some of that money's got to burn off.
Yep. Well put.
And I would love to hear actually your thoughts on too with the low inventory. But I'm back to seeing many multiple offers on really price points, even up to $2 million. I've seen multiple offers where we've had to do quick closes, waiving financing, releasing earnest money. That's come back. It seems like hit or miss. It seems like it deals with how the house is priced, but is that kind of what you're seeing as well?
Yeah, definitely. I mean, the housing market, for those ideal homes in those neighborhoods, whether it's a school as a driver, whether it's just the general location. Yeah, I mean, those are definitely having multiple offers. And I think the price range is also, the getting squeezed is probably right around 1.2 to 1.5.
Okay.
That seems to feel like the housing, and definitely we hear different stories in the 1.8 and plus range with multiple offers for sure. But this feels like there's a lot more people in that 1.2 to 1.5 range, and they're definitely battling it out. But it's weird though, because every once in a while you'll get a home that you think definitely is going to go with multiples, and you have tons of showings, and then all of a sudden there's only 1 or 2 offers. So there are some kind of weird hit or miss scenarios out there. I do think it's important to also in this conversation just to identify the fact that obviously condos and houses are 2 extremely different beasts.
Different.
But yeah, you have, the condo market kind of follows the housing market, right? And as you said, right now, there's just such great opportunity for condos, and how they were, they came down in price so much over the last, 3 years. We are seeing a lot more buyer activity downtown, which is great. It's consistent, but we are not seeing really those multiple offers quite yet. So, and it only takes, and I do remember when this happened back in 2012 to 13, it's like overnight, all of a sudden,
Yes.
then, all of a sudden you start seeing multiples and you never saw it coming. And by that time it's too late.
Yeah. Oh, absolutely. Like I look at some of your listings and I go, oh my gosh, these are phenomenal buildings, fabulous units. Like, I mean, a 2-bedroom condo unit, like for years was like, oh my gosh, I can only hope to get a 2-bedroom condo. It was completely out of reach for a lot of people's budgets. And now I see it in like phenomenal buildings like Scala, Insignia, Fifth and Madison, and just really, really 5-star buildings. And I just think, gosh, I mean, for people that are, looking for that kind of lifestyle, and having lived that lifestyle myself for many years, it was great. It's really nice. It's very low maintenance.
Yeah.
Or people that are looking to downsize or have like a second home downtown. I've had clients that are doctors, up on First Hill that say, sometimes we were long shifts and we want to have a second home. The thing a lot of people forget about, there is no actual mileage requirement in the guidelines for a second home. It just has to make sense. So if that's really what the person's using it for, and it makes sense, like in that case, a doctor that, might have their house down in Tacoma, or but yet they work a lot of shifts and they want to have that condo downtown, it can absolutely make sense. That's just one example. There's a lot of different examples too. That there's such opportunities. Or the first time home buyer, there's a lot of units that have now, I notice anyway, the price points have really come back down to where, gosh, our first time home buyer can really jump into it. And that's where all first time home buyers used to really start.
Yep.
So I'm hopeful that in this market that will get them onto the homeownership ladder.
Yep. So we're kind of operating that 2000, let's say 16 to 17 price points. I looked that up about a couple months ago, but that should be still pretty relevant to where we're at. I think that a lot of the new construction buildings, Greystone specifically, is offering for, doctors, like you said, that's a great location for a new construction. Also first time home buyer. I mean, honestly, you get free dues until 2025. They have some great floor plans. It's in kind of an emerging location that has really good access to the freeways and, all the different neighborhoods on that side of the city. So, there is a lot of good product out there, but inventory is not crazy. I mean, I've been watching for downtown in general. We've been maintained pretty consistent. We're creeping a little bit up right now just because we're in, the heat of the spring, and that's when we start seeing more listings coming on, but we are equally seeing them come off and go pending and sold too. So if we saw a glut of inventory like what we did in during COVID, July 2020 or something like that, we would be a little bit more concerned about the condo market, but it's maintained very consistent level of inventory, and the values are not wavering. If anything, we're definitely up year over year as far as what everyone's reporting. So
yeah,
that's good news.
Well, it's interesting too. The other trend I've seen is, let's say you have the buyer that has their big house and they're at a really low interest rate, like 3% or below. And they're like, gosh, how do I justify moving to, another property where my payment would double? A strategy I've seen is those people are saying, okay, well, maybe I'll stay put with my primary residence, but I'm going to go buy a second home, either, somewhere around here, or they buy in Arizona, in a more affordable area where they can buy and kind of, get that lifestyle that they're looking for. And that's definitely been a trend. I would say that we started to see it in COVID. Definitely it's continued for sure.
Yep. And important to note here for everyone, Carese does work down in Arizona as well. And so can definitely assist in that ways for that location.
Yeah, that's a fun market. It's a fun market to see, and very different areas there have such a different vibe and a feel, and yeah, I like that market.
Yeah, we love it.
Yeah. I think
it's complementary to the market here. So we always say the reason why we love, Arizona so much is because we have we have Seattle basically. So that's our personal kind of mantra within our family is, why we love it. So because of the lifestyle that's down there too, but we get the balance of both.
And you can easily get there. I mean, with Payne, I don't know if you've ever flown out of Payne Field, but
so easy.
It's such an easy flight down there. And it's like, it's easy. It's 2.5 hour, 3 hour flight and you're there versus having to go all the way to the East Coast. So yeah. And kind of, we touched on this a little bit, but where these are two metrics I think that are really important and unique in this market is credit card debt is at all-time highs for people, and savings is at an all-time low. So and definitely in underwriting, I would say we've seen guidelines tighten, and underwriters have to look at liquidity. They just want to make sure that borrower isn't completely house poor after they close on the house. I think that's a good thing because we're not going to have what happened back in 2008 with the financial crash. I mean, people really, really have to qualify. And that's been that way really for about the last 10 years. But I do think with the savings being at an all-time low and credit card debt at an all-time high, it has challenged people. And people have to get savvy with respect to like programs that we're doing and strategies that we're doing. And I find that I'm really going deep with clients right now on the financial piece, like almost doing kind of like a financial analysis with them and like seeing where they keep their money, making suggestions to them to keep their money moving so that it's working for them. So it's not just, you know, stagnant, and I'll kind of explain a little bit more about that in a minute. But some of the programs in today's market that are really moving the needle is, and you and I've done several of these with clients on the 2-1 Buydown program, is a great program for buyers that are looking at a home or a condo where there's some flexibility with the seller for a seller credit, whether that's building it into the offer, whether it's maybe the seller was contemplating a price reduction. Instead of doing a price reduction, they can keep the same price and offer a credit to the buyer. And that credit allows the buyer to get a temporary buy down of 2% below current market rate for the first year and 1% below current market rate for the second year. And that can make a big difference in cash flow for people. That's the one and only program where a seller's credit can actually impact monthly cash flow for a buyer. And so essentially it's a great strategy where a buyer's kind of looking to get into a certain price point. But if they have to, if they had to make the payment based on where the rates are today, it might be a little uncomfortable. They can still qualify because they have to qualify at that rate, but it's just uncomfortable. And it's a great way to bridge the gap between now and when we think that people are going to be able to refinance at some point over the 2 years. Bridge programs are back. These are awesome programs. I know not every lender does that. We've got 3 different bridge programs that are awesome, awesome loan programs. And it's great because, you know, let's say you have that move up buyer that has equity in their current home and they want to be able to tap into that equity. Maybe they don't want to sell stock that they have, or maybe they are just equity rich, but they don't have a lot in cash. It allows that buyer to tap into the equity of the home they own and use that as leverage for the down payment for the new purchase. And they can buy non-contingent on that new. They're more competitive. They can get maybe the house that they want to buy. And then they also have time, because there isn't a time limit on when they have to sell that departing residence afterwards. And the great news is those bridge programs allow a buyer to, after they've sold their departing residence, to pay down that loan balance with proceeds and then recast the loan amount so they can get their payment exactly where they want to have that payment. I love these programs. I do quite a few of them. They've definitely come roaring back in the last few months for sure. There's also a brand new program that came out the end of February. I did a video on this. I think we posted it a couple weeks ago, but it's a brand new program. It's called the SAVE program. And what it is it's for student loans. And the cool thing about this program that's different from the other ones that's out there is it actually looks at income and family size to determine what the payment is going to be. It doesn't just look at the remaining loan balance like a lot of programs do and just income. Looks at family size. And then let's just say the payment is set at a certain amount. Let's say it's $500 a month. But that $500 a month doesn't cover what the full amount of the interest would be for the remaining balance. the government actually subsidizes that overage for people. So that loan balance doesn't go into what we call a negative amortization. It actually will just say, okay, we're just accepting this $500 and we're just going to write off the overage on the interest.
Wow.
I think that program has the ability to move the needle with first-time homebuyers, because I've seen situations where the payments were cut in half for people. If you've got $1,000 payment and now your payment's only $500, that buys you about $75,000 in buying power in today's market. So, it'll take about 6 months before we see
Yep.
how
And
it
so
moves the needle.
So you have to have certain income guidelines for that, of course, right? Yep.
Yeah. It's going to look at income. It's going to look at family size for
Yep.
sure. Those are the two metrics. So it's really important. People just go Google the SAVE program and they can see how to apply for it, see how it may impact them. I've told a couple of clients of mine to go check it out. And one of them, it was like more than a 40% reduction in her payment.
Wow.
So it can be a
Awesome.
good tip.
Yep.
Down payment assistance, there's programs out there for that. I like them. I think they're good. I think it's always better from a financing standpoint if you can basically, if you're needing to finance down payment, you can do it through other means, which we'll get into here in a minute. But the down payment assistance programs are out there. Typically, you're going to pay an elevated rate on the first because it is 100% financing. So there are other strategies you can use to go 100% financing, but it looks like you've got a down payment on there. So, that's kind of where that's kind of one of some of the trends that I see in that direction.
Mm-hmm.
Yeah. On strategies, kind of like what we were talking about condos. I think we are starting to see people go back into condos. But man, if I could tell any first-time homebuyers right now, or move borrowers looking for that lifestyle, condos are your best, really just your best opportunity right now.
I love that.
Yeah. Yeah, it's true. I mean, we want people to get on the home ownership ladder sooner rather than later and start building their own wealth. Yeah. A very interesting strategy too that I love and that I've talked to buyers about is whole buying in reverse. And this is different than what most people think. Most people think, well, let's start off buying our primary residence. And for the most part, that's what you would do. But if you live in an area that's more expensive and it's just outside of your budget to start with buying your primary residence, a great strategy is going to a market. If you want to stay living in your high cost area, go to a market that's like cheaper. Like, let's say it's a college town in Wyoming, or it's a college town in Oklahoma, like where you can buy a house for $150,000 or $100,000. And you buy that house as a rental property. At least you're jumping on the homeownership ladder and you're getting the benefit of appreciation, and you can rent that property out and it will cash flow or even drive a profit. And if clients can do that a few times, that will allow them to save up the money to be able to, in a few years, go ahead and buy that primary residence in their desired market if they don't want to move to a whole different market. But I've had a few clients do that. And it's one particular client, it took them about 5 years. But they bought some properties in Texas. They bought some properties in Arizona. Yeah, and they were able to do that. And they got positive cash flow, positive passive income that was coming out of those rentals that could be used in their qualifying ratio. Most importantly, it made them feel more comfortable with what the payment would be for a house that they really wanted here. But sometimes to get to the goal, sometimes it's not a straight line. Sometimes it's going to be a little bit of a winding road, but that's okay. If you get there, that's what the important thing is. So I think that's a big trend this year. And something I talk to a lot of clients about. Yeah.
Nice.
Have you seen people doing that?
Oh, yeah. Yep. I mean, a lot of my clients are diversified in different areas, and that's what sparked again 3 years ago getting licensed in Arizona, and then next year we'll be licensed in California and Idaho. We have New York on the list. I mean, there's a lot that we have, we've identified within our client base, and most of them are investors anyway because they're coming to us on the rental side through Seattle Rental Group. That they have that mentality. But yeah, like you said, it's a great way for even the first-time home buyer, right? You don't have to feel pressure to buy your home, let alone your dream home in your first purchase. Buy an investment property. Don't live there. Stay where you're at because you're there because you're working. You like your neighborhood. You like your five-star building that you're living in and renting. But be investment minded to where you could be plugging your excess funds so that it could generate money for you and capitalize on the appreciation, like you said, and cash flow. So
yeah. Oh, absolutely. In the beginning, we were kind of talking too about this bank of family is a big, that's kind of a strategy I'm seeing too. And over the last 5 years, I've seen more and more family helping out their kids, especially when you're, the millennials, but then Gen Z, like I said, savvy. They're savvy with finances. They're very smart generation, but this is a tough road for them to buy a house. And, I think that we're going to probably see more of them go to their families to help out with down payments if their families are able to. So, from an estate standpoint, and I've learned a lot about estate type planning. And in doing that, there's advantages that families can do by gifting money to their family while they're still alive, as opposed to waiting until they've passed on. And in doing that, this can allow that new generation, or anybody for that matter, that potentially is down payment challenged, is cash strapped. It can really help them get into a home. So I always encourage, families to have these conversations. They're tough conversations to have. They're very emotional conversations to have. But, the old saying goes like, sometimes it's better to be able to give with a warm hand than with a cold hand for many, many reasons. And so, that is a trend I'm seeing more of, and I think it's a good thing, but it's just a great conversation to have with clients because there are a lot of parents that do have the means to be able to do that. And by getting that next generation onto the ladder of home ownership early, it just makes a big difference whether you buy a home at 25 or you buy a home at 40. It's just a massive difference in wealth, which leads into my next thing. One of my favorite sayings in this world is make your money work harder for you than you did for it. And the whole concept is to keep your money moving. We're in a really expensive markets and everything's more expensive. A lot of people don't realize that, let's say you get your paycheck and it goes in the bank account. If you just have it in a regular old savings account, like a retail bank, like a Bank of America, Wells Fargo, Chase, you'd probably be scared to see what you're really earning on it. Like it's likely those checking accounts are typically at 0. Savings accounts are like at 1/4 or 0.5%. Mm-hmm. So I like to talk to clients about being mindful of looking where you've got your money. Like when you've got inflation at 3% or 4%, if you leave your money there and it's only earning 1/4, you're literally going backwards every single month. And it's hard to save when your money's going backwards. So there's a lot of tools out there that are very, very safe. Like I'm a big proponent of high yield savings accounts. So you can get high yield savings accounts right now for minimum investments of $1,000 sometimes, and you have access to them at any time, and they'll pay like 5%. So at least you can beat inflation. heck, the S&P, if you're comfortable and you feel like you're savvy enough to go in the market, even just a simple S&P 500 ETF fund. I personally like SPY, but there's a lot of them out there. And there's, do your research, but there's a lot of them out there. This year to date, the S&P is at a 20% return. Now, I don't know if that's the case over the last few days, but up till then, it was about at 20%. Last year, it returned 26%. It's a diversified fund. So you're getting the diversity in there. But I like to encourage, especially my buyers that I know are kind of out looking at homes, but pre-approved, keep your money moving so that it keeps making money on top of it. That's only going to help you between, especially now and when you're going to find that home and beyond. So
like that.
Yeah. Yeah. And kind of next comes into who we were talking about, condos. There's been big changes in condos, which I think are good actually for buyers. It protects buyers.
Yeah, definitely.
Have you run into very many condos that you found where these changes, which we'll obviously talk through in a minute, where it's been a deal killer?
No, I haven't, because we've been able to identify those before we went down the path.
Yeah.
So I think that's important, is, making sure and then identifying those of okay, this is actually going to work, or there's no way that this is going to work.
Yeah.
So, yeah.
Yeah. With these review changes, it's anytime you have a major issue like what happened in Florida a couple years back, our industry always goes completely way overboard, and they've gone overboard. I think some of these changes were needed, but of course they've gone overboard, and now they're starting to kind of come back a little. But the recent changes definitely warrant planning with condos, I think, and it really targets projects in need of critical repairs. And I kind of thought I'd love to kind of run through like kind of what's okay, what's not okay, special assessments, inspection, and some of the documentation you would expect to see. But really what it comes down to is, like you said, and you're a very, very versed, like you're an expert in condo, so you know what to look for up front. And as a loan officer, because I do a lot of condo lending, I know what to look for and I know the questions to ask. But there's a lot of loan officers out there, unfortunately, just like there's a lot of realtors out there in the market that don't know condos and they don't know what to ask. But yeah, it's mainly looking at material deficiencies that, if uncorrected, could cause a critical failure in the next year. And the biggest changes are unfunded repairs that cost more than $10,000 per unit, that should be undertaken within the next 12 months. Now, like I've got here, this doesn't include repairs made by the unit owner or repairs that are going to be funded through assessment. It's mainly those ones that are out there that, like, there isn't a way that's been figured out yet of how it's going to get paid for.
Yeah.
So, some of the critical stuff can be like seawalls, elevators, waterproofing, foundation, electrical, anything structural in nature is something from a lending point of view, is going to come up and be problematic. If the person's paying cash and they're okay accepting that, then that's good. It's just the lending point of view. Damage or deferred maintenance, if it's limited to a few units and doesn't affect the overall safety and soundness, you're going to be okay. Routine repairs that are preventative as part of normal capital requirements, repairs accomplished through a project's normal operating budget or special assessment, that's all going to be okay. Yep. Really, what's not okay is like if you get a project that's got an evacuation order, partial or full, for unsafe conditions. Yeah, that's gonna be a problem. I can't imagine many buyers are running to those projects, but there's probably a few. I don't think we have any of those in Seattle right now.
I haven't ran across any. I mean, there's probably one or two borderlines that just haven't declared. And yeah, actually I have one or two in mind actually as we speak, but
Yeah.
they're working through it.
Yeah. You know, and I think one of the biggest questions I always get is with special assessments. And again, special assessments doesn't kill a deal. It really comes down to what's the scope of it? What is it that it's about? Like, is it structural? Is it health safety? You know, and we're going to need to see all that. We'll need to see the purpose and scope of it, the original amount of the assessment, what amounts been paid, what amounts is remaining, expected date that it's expected to be paid in full. The big concern is always, is there enough money there? And is there a plan to pay it so that the work gets done? You just don't want the work to not get done. And we can all think of condos in our past or even apartments that, you know, there just wasn't the money to fix it and the condo suffered because of that. And the big thing, no more than 50% of the units can be 60 days or more delinquent in their special assessment. That kicks it out of being what's called a warrantable condo that qualifies for traditional financing. It doesn't mean, you know, if it does get kicked out of traditional financing, you know, we have non-traditional loans that we do all day long for non-warrantable condos. They just require a bit more down payment and the rate's a little bit higher. You know, so it's still an option, but it's really just like you said, being prudent and upfront, knowing what we're looking at. This is kind of one of the newer things too, is before as a lender, we didn't need to get a copy of the structural or mechanical inspection. But if there has been one done in the last 3 years, we're now required by the agencies to look at it and just do our due diligence and make sure that there wasn't anything that was critical or regulatory or, you know, evacuation orders, you know, basically just do our due diligence and make sure that, you know, if there was work that needed to be done, it was done. So the buyer is safe. So our loan is safe. But those are kind of the big ones. These are the two new questions that are on the HOA. And you know what's funny, Ashley? I've seen a lot of property management companies they've had a challenge with, I think, getting used to these new questions.
Yeah, on the questionnaires for sure. I mean, that's an ongoing problem. And we could talk about the resource certificate side of it, and the lender questionnaire side of it too. But yeah, I mean, they're for the most part, what I've seen is, yes, the management companies of all these buildings have a hard time grasping what is required, how to interpret, how their building, like the homeowners association, wants them to respond. And I don't think a lot of them also understand the repercussions when they go one way or the other with it.
Yeah, it's interesting. A lot of times we'll get those two questions and it will say NA or it just won't be filled out. Or they'll say, look at the minutes. So as a lender, we don't like more information that we don't ask for. We really just want the info that we ask for, because sometimes too much is too much. Like, you know, less is more. But and we'll go through it if we have to, but sometimes then stuff comes up that you weren't anticipating comes up and it causes problems. But you know, for the most part, it's the same documentation, the condo questionnaire form. I always ask for a resale certificate, as you know, because I can look up front, is anything jump out to me as being a challenge or problematic. Resale certificate doesn't include all the same questions as a condo questionnaire form, but it will give us a good idea if there's an issue. Same with the condo master policy. If there was that report done in the last 3 years, I always like to see a copy of that. I like to see a copy of the reserve study, budget, you know, those types of things, just to get a feel for, you know, is there going to be any kind of problems, or what way do we need to go? Are we going to be warrantable where we can do traditional, or do we need to go non-warrantable where we're in a portfolio type loan so we can set expectations with the seller as well as with the buyer? I I think the biggest thing for sellers is, because I think a lot of times sellers, they're not keen on ordering that resale certificate up front, right? They want to wait.
Yeah, we always try to get ours up front, definitely, because that helps us also, because we'll
Yeah.
know more about the building. Inherently, if we have the document, we like to say, hey, it's a healthy building. This is how much they have in
Yeah.
reserves. This is what's going on. So it actually, every owner should pull it ahead of time, because problems always arise if you don't.
Yep. I would say to a seller, it's the best money you'll spend. And you're always awesome. You always have that documentation when we're working together, so we can see that. But I've noticed there's a lot of people that come to me that don't, and we just don't have any way of knowing until we can see that information. And it can just save a lot of time and effort if we know up front about that. So
thank you so much for chatting. I guess I would like to know, as far as kind of your thoughts looking to the future in rate locks for the transactions you have currently, given what happened this last week.
yep.
And are you encouraging your clients to lock their rates? Or are you kind of saying, okay, let's let the dust settle a little bit and see how things are going?
It's always going to depend on what their time horizon is. For
Mhm.
clients, for like a kind of a traditional transaction where a client gets into contract and we've got like a 30-day or less close, my motto is always your best to lock. And the reason why I always encourage locking is 30 days is a really short window for, if let's say, rates are where they're at today, and next week all of a sudden they shoot up like they did this week. I mean, we had a 0.25% increase in one day. We had 4 rate changes for the worse a couple days ago because of that inflation report. The challenge is if a person floats and they got to close in 30 days, there's not a long time horizon for the market to recover. And that's their payment. That's the money they have to pay. So I will always recommend highly that once they're in contract, we lock the rate in. Look, if over the period of that 3 weeks before we're about a week away from closing, if rates plummet between that time period, like drastically improve like 0.5%, it has to be 3/8 to 0.5%. Can't be an eighth, can't be a quarter. That's just kind of market fluctuation. But if it drastically improves over that 3 weeks between when we have to get the final closing disclosure out before closing, we can always do what's called a float down. So the risk, the downside is limited. Like if you lock, at least you're protected. And I always ask the simple question, hey, are you going to feel worse if you don't lock today and then rates shoot up a 0.25% between now and when you lock? Or are you going to feel worse if we lock today and rates got an eighth better and you missed out on 1/8?
Yeah.
Most of the time they're like, well, I wouldn't want to be floating and have rates go up. It would cause me anxiety. So then we kind of talk through it and they usually lock. So I think for a regular transaction, locking, definitely a locking stance. This market is way too erratic. There's too many influential factors right now that are affecting it. Not only do we have our debt, our credit card debt, we have inflation, we have lowest point of savings here. We've also got the Ukraine stuff. We've got the Israel, the Persian, or out in the Middle East. You've got the China Taiwan issue. All of that causes uncertainty in the market, and those are all influential factors that are going to contribute to interest rates. So for the most part, I'm a locking stance. Now, if somebody's buying a new construction home and we don't know if we're 60 days out or 90 days out or 120 days out, we all know new construction can be delayed. You have to have a pretty good idea of when that closing date is before you're going to be able to lock. So if a client's like, I don't know if it's, 120 days or 150 days, you kind of have to float on something like that. And I think that if you're not closing on something till fourth quarter of this year, I would, in most of those cases, I would opt to float and just kind of see things. There's a long enough time horizon that you can get a sense of the direction of where things are gonna go before you absolutely have to pull that trigger on a lock. So
Good. So lock.
if you're
Lock,
in contract, you lock.
Yeah.
Yeah, you are obligated to buy that property. I mean, in most cases, people aren't planning to back out. So you got to close on that. You don't want your payment to be adversely affected.
Yep, definitely.
Yeah.
So thank you so much. Like I said, Carese, you're just a wealth of knowledge, and I really appreciate your time.
My pleasure. Anytime.
All right.
Have a great weekend.
Yep, you too. Bye. Thank you, everyone.